All right, guys, we're recording, and let's go around real quickly, and we're going to be discussing some mortgage stuff today. This idea, Danny, came up Friday when we had a conference call, and so we're going to put this up as recording to help people understand. But here's who we have: Mary Miner, broker owner, Nextage Realty. Sheryl Cota, Cota Designs, does the social media management for Nextage. Danielle Smith with the Impact Mortgage Group, and Hurdie Burk, yours truly, is a consultant, marketing consultant. So, hey, Mary, tell us a little bit about Nextage Realty to kind of catch Danny up, where you're at with the new building, how many agents you have now, what's going on.
Well, Nextage has been around since 2010. I purchased it in 2015. We went on a big adventure almost about 2 years ago. I got sick of paying rent, so I was going to build a building. So we're in the process of building a building. The only thing we're waiting for is flooring, and we'll be ready for the appraisal. And it's located at 180, basically 183A in Crystal Falls. It's right across from Rouse High School and Wiley Middle School. In front of that new community, Century Builders. So we have a new office. It's going to have the green room, and it's going to have the training room. It's going to have conference rooms and stuff. And so hopefully we'll be in there sometime in May. That's the plan. Don't know when they'll actually be allowed to do a grand opening, but hopefully we'll at least be in a building sometime in May. Broker owner. I've been the broker owner since 15. I've been a broker since 2006, and we have right now 30 agents.
So that's good. And Sheryl, go ahead and introduce yourself. You can do it. Come on. Turn your volume on. You're muted. You're muted. You're muted, Sheryl. Unmute yourself.
There we go. Is that better?
Yeah, it helps.
All right.
We're trying to read your lips. It was a little tough.
I'm Sheryl Cota with Cota Design. So I do the social media marketing for Mary for Nextage, and mainly just the graphics, the social media, making sure that everything is and posting things that to understand more about the real estate market as of today. So.
Okay, I'm disabling my VPN real quick. I forgot to, and that's probably why we're getting a little background noise. So there we go. All right, Danny, go ahead and say hi and introduce yourself.
Hey guys, Danny Smith, Impact Mortgage Group, Impact Coaching. Been in the mortgage business 36 years this month. What do you want me to say, Hurdie?
Well, the whole point was we wanted, Mary's concern is that people needed to get some information on what's going on with the coved, what's been happening, understand what's going on with mortgages. Maybe you can fill us in on forbearance and delayed payments and institutions. Catch us up on what's going on in the finance industry, if you don't mind.
Yeah. I could go down a couple of paths. What's interesting is that I'm seeing, having been in the business as long as I have, I'm seeing changes taking place. Some things are kind of scripted, right? What happened back in the 80s with the S&L crisis and what was called what became known as the Southwest Plan, that there's some rumors out there we're going to have problems due to banks and the financial world wanting to downgrade property values. That's not going to happen. The majority of our loans are 30-year fixed rate mortgages, and loans we're on a loan can't be called due. I've actually had borrowers call me, 2 borrowers called me and say, my property value might be dropping. Is this going to be a problem? And I said, not as long as you make your payments. And so the forbearance Forbearance means, in and of itself, there's a difference between forbearance and deferment. A deferment is a loan that is put, for simplistic sake, it's put on the end of a loan. So somebody has a 30-year fixed rate mortgage and they have a forbearance, or they have a deferment, or let me back up. They stop making their payments for a period of time. That payment on a deferment is put on the end of the loan.
Mm-hmm.
A forbearance, the way the rule is written right now, I've got the copy of the Congressional Act, pages 568 through 572, deal with forbearance. A person asks for forbearance for 180 days. If you have a Fannie Mae, Freddie Mac, an FHA, a VA, or a USDA loan, you tell your mortgage company that you want to stop making payments. You can stop making payments for 180 days.
Oh, it's 180 day, not 90.
90 is what Fannie Mae and Freddie Mac originally came out before the Congressional Act, the CARES Act, COVID-19 Act. Before it came out, Freddie and Fannie put out rules around a 60 and a 90-day rule. Then the CARES Act came out, and it said 180. So it, overwrote what Fannie and Freddie have said. Now Fannie and Freddie have updated their rule. At the end of 180 days, somebody, if they're still in hardship, it can be put off. They can put off payments for another 180 days, for a total of 360 days or 1 year.
Wow.
The challenge is that at the end of, and now at any time somebody can start making payments again. The challenge is that the way it's written today, and until it changes, when a person starts making payments again, they have to get caught up. Now, what happens if they don't have the money to get caught up, and the normal person is not going to have the money. A person that truly goes into forbearance because there's hardship, they're not going to have the money to catch up. So then they go into loan modification and look at loan modification options. And at that point, they're going to have to submit P&L, financial statements, bank statements, pay stubs. They're going to have to go through a qualification process to see with the servicer, with their loan servicer, whoever they're making their payments to see what they qualify for. Now, it might be that those payments get pushed to the end. That's unlikely based upon the state of the liquidity inside the mortgage industry right now. The lender wants to get their payments.
So how is that going to affect the servicers? Because
what happens with the servicers, when the service, you're making your payment to your mortgage servicer every month, that servicer is making the payment into, simplistically, they're making it into the mortgage-backed security pool.
Right.
It's that pool that investors have bought their shares into. A retirement fund, for instance. You might have a 401k that has investments in mortgage-backed securities. Right. So you want your return on your 401k. That company wants the return, whoever you've got your investments with, they want their return. To get their return, they have to get their payments from the servicer. If you're not making your payment, the servicer still has to pass on those payments. And that's where the liquidity problem comes in.
Yeah.
The nation's #2 lender, when Fannie Mae came out with their 60, 90-day forbearance rule,
Mm-hmm.
the next day, Quicken, who's #2 or #3, it became known the next day that Quicken was looking for $1 billion in cash infusion, because they figured that 25% of their business was going to ask for forbearance, and they didn't have the cash to keep that going.
Wow.
Now, I didn't get numbers for last week. I haven't looked them up yet this morning, but the #1 servicer said the first 4 days after President Trump signed the CARES Act, they had 2%, 65,000 borrowers in 4 days asked for forbearance.
Wow.
And who's that? What servicer is that?
Mr. Cooper. You might have seen their ads on TV. They're a conglomerate. That's a company that they came together. I forget the name. I forget who all they bought. They bought some different big servicers and formed this one company now called Mr. Cooper about 2 years ago. So that's the problem, is that right now the servicers don't seem to have the liquidity. Now, banks, they can go borrow it from the Fed. They're too big to fail. All of these companies are, quote unquote, too big to fail, but just what happens with these servicers, and are there going to, and now let me give you my personal concern about all this, is that there's some constriction that goes on inside the mortgage industry. There's fewer mortgage companies to keep this thing competitive coming out of COVID-19, and which is going to take us months, even a couple of years, to come out of this thing, and what happens and who survives. We know that back 10 years ago, we come out of the 2008, 2009 thing, we lost around 60% of our mortgage companies nationwide, and things could have been much more things would have been much more competitive during that. Now we're back again, and the mortgage business is flowing. There's a lot of competition. The spreads are becoming minimalized. The spreads aren't there. So it keeps everything competitive. We're all competing for loans, and if we're not competing, if we don't have enough competition, we're not competing, and that's one of the concerns coming out of that the small mortgage companies are going to go by the wayside again. Anyway.
Wow.
You seen any, Danny, I know there's been a couple dry closings, but have you heard of many dry closings lately?
You talking about the remote?
Yeah, or like the mortgage, the lenders that realize they don't have the money and all of a sudden don't fund?
Wait a minute. Okay, say that again.
The dry closings, the ones that get all the way through closing and they don't fund because all of a sudden.
No, I have not heard. That that's happened. One of the concerns here also is the warehouse lines drying up, like they did back in 2008, 2009. The warehouse lines, like for us, we underwrite for about 15, 16, 17 different companies, but we underwrite them and then we close and fund them. And we have to have a warehouse line to fund them before we sell, that holds the loan before we sell it. There was definitely the warehouse lines are causing some of the new restrictions in mortgage lending. But I haven't heard that we've had quote unquote dry fundings.
It hasn't happened with us, but another agent said they closed 8 days ago and still haven't funded.
Oh my goodness.
So what does that mean?
That means all the documents are signed, everybody's agreed to everything, everything's at title. And then when title pushes that button to fund the loan, the money's not there.
Yeah, that's that's one of the boy, you bring back shivers from 2000 and late 8 and 9 right there when that was happening as warehouse lines dried up. So we have had program changes throughout the industry. FHA has on FHA loans, the pricing has gotten worse on credit scores below 680, requiring reserves and things like that. Some of that is due to warehouse lines, and that warehouse lines don't want the lower credit scores stuck in those loans sitting there for a few days to a week or to a couple of weeks.
Wow.
What I would say on your side, Mary, is the like down payment assistant loans. Those loans have remained. And it's one of the loans that we specialize in. Is that, and those credit scores at 620 to 640 are still good. 640, even 660, anything below. Companies are still doing that. We're still doing them, even down to. I know we're doing down to 640. I've got one of our DPAs I've asked about. The matter of fact, let me look right now. I just pulled that up before I realized. Hold on a second. Let me look this up. Yeah, we have. We're good. A TDHCA 620 credit score, and we're still funding those loans, and those rates are good. That rate's 3% today on a 2% DPA. Yeah.
Because I've heard some that have not gone that high, that are still staying lower, but they're saying basically because they have, I guess they're bankers, so they have the actual money that they can fund if they have to. Yep.
So Danny, in a simplistic way to help me out understand this better, what is the government trying to do right now to keep this all in check to a certain extent? What are they buying into? What are they doing to slowly buy, or what are they doing to help you guys at this level?
Well, right now, there have been no changes to date with what the government said is that there's forbearance. It's 180 days. If you've suffered hardship, contact your lender. You don't have to provide any documentation of your hardship. You say there's hardship, they have to give you 180 days. That's all that's happened so far. Fannie, Freddie, FHA, VA, USDA, none of the agencies have changed their guidelines. Lenders across the nation have changed their guidelines based upon credit scores and reserves and those requirements. What's going to come out of this to assist the lenders with their liquidity with their cash flow, that still remains to be seen. There's been some committees formed, Mortgage Bankers Association and the Mortgage Brokers Association have both. They're doing some things and lobbying to keep everything as normal as possible through this.
So, but how do we get the message out? Because not everybody reads all the fine print.
No,
And
and,
how do you get the message out that at the end of the 180 days or the 90 days or the 365 days that they have to pay back what they owe? Because
Yep.
I know they're calling for forbearance because they're going, oh, this is a great way. I don't have to, I got laid off or whatever, but I've even had, I've heard it from the agent side, and I'm like, don't do that because they're going to ask you for the money.
yeah, and I'm going to send you a this little thing that I don't know who first came up with it. I didn't. I saw it. I got it in an email, I think, and it's an example. Forbearance isn't forgiveness, and it gives an example of how that works. And I've been sharing it. You just remind me. I just dawned on me. I haven't shared it in 4 or 5 days. I was sharing it on Facebook, sharing it on LinkedIn, sharing it on Twitter. A lot of other people were, but there's still a lot of people don't read all that. And the lenders are inundated. The servicers are inundated with phone calls, and the people there, they can't tell them what happens at the end. And the normal process is that if you ask for forbearance, when you start making your payments again, you have to get caught up.
Right.
And then if you can't, then it goes into that loan modification. And that's not a fun process because you're behind on payments. You get, hopefully this time they'll work with people through that, because always in the past, and you just get turned over to the collections department. I mean, loan modification is part of a collections department at a loan service.
Well, I have a friend that's a lawyer, and he got out of law school right before all the 08 stuff.
Uh-huh.
Right? And so he specialized in this. He specialized in loan modification, short sales, and everything. Made an absolute killing. He's already talked to us. My REO division is getting ready, and he's already talked to us to open up Austin, because he has Houston and San Antonio, and he's ready to open up Austin because he knows what's going to happen in the next year.
Yep. Yeah, it's and it's going. I mean, there's people again. They're going to start losing their houses, and some people are just going to go. I can't put up these phone calls, but they're loan collectors. I mean, they're going to call you every day. They're going to call you, and there's going to be some type of. I mean, what was it? The program that I forget what it was called, that it got so bad in 08, 09, and 10 that Congress passed a law that if you left your house in good shape and would work with the lender, even in a short sale, that you get a $2,000 check.
Oh, they get cash for keys all day long.
Yeah, cash for keys. That's right. Yeah, and that was in part just to give people to kind of bribe them to just work with us to get out of your house. And
we were giving away sometimes on cash for keys between $5,000 and $8,000.
Really? Wow.
Mm-hmm. And they were letting them rent the home until, because there were so many on going up, they would let them rent the home for 60, 90 days through the bank. And then, once it went through foreclosure, and then instead of cash for keys, we'd give them 90 days and they'd have to pay the bank and they could find another place. But yeah. And I mean, we're talking cash for keys, people that left their whole house there. They took the $8,000 and walked out. Wow. We had to do estate sales and everything back then.
Yeah. So those companies that were that were managing REOs, and I think it's smart on your part to get ready for that. I mean, unless something happens here in the next 90 days, that may be part of the economic recovery plan, that's that President Obama is talking about, that somehow or another. I mean, here's the bottom line.
President Trump or President Obama?
President.
I'm sorry, I meant President. I was thinking about Obama and the Obama plan. I was trying not to say that a while ago. And so that President Trump is talking about, maybe it's something that wraps. I mean, the bottom line is, you take a retirement fund, your 401k, everybody's 401k, has some mortgage-backed securities. So if that money's not being passed down, somewhere the cash has got to be infused there, even if, even as they're consolidated and a big bank buys out a servicer, somebody has to infuse that cash in to keep flowing into our retirement funds, and to keep those from failing.
Right.
So foreclosures doesn't help the retirement, because if there are as those loans go into foreclosures, that's when the servicer, it's part of the thing. The servicer it benefits the servicer in part. It benefits them to put a loan into foreclosure, because that's when they stop making their payments into the retirement fund and get reimbursed for the payments that they did not get.
Right. And I think the biggest difference between this time and '08, there's not a lot of second liens.
Well, that's a great, that's very insightful, Mary. And yes, you are absolutely, you're right. There's not near the second liens there were before, and you don't have that cushion in there. You got yeah.
Because I mean, the second liens were the hardest part on doing short sales and stuff, because you always had to get the second lien holder to agree, understanding that if you go to foreclosure, he's losing everything. But you still sometimes couldn't get the second lien holder to agree. He goes, no, I'm not agreeing to that. And I said, okay, then you get absolute zero. I mean, I just didn't understand their philosophy at all. But I think, in a way, it'll be easier to work with just one lien holder, is what I'm saying.
Right.
We have to get to that point.
Yep. Good point. And maybe it'll go faster. Yeah.
I hope.
So what's the, so as a layperson not involved in either one of your businesses, what is the immediate future? Is the virus thing, because the economy was so good, is that a good plus thing that we could bounce back fairly quickly? Or will this just take forever to come out of, because so many people are asking for forbearance and it's really going to hurt the industry? Did I ask that right? Did I ask that right?
Yeah, I don't think it will hurt our industry. Everybody's going to be buying and selling. That's not the issue. I think what's going to hurt is the current housing. People are not reading or understanding forbearance. And we're going to see that in 96 months, 3 months, 6 months to a year. We're going to see that fall out because people didn't read what they signed.
Yeah.
And
that makes total sense.
Yeah. And that's, what I'm hoping that lenders, let me say this, what we've rolled out effective today, I think, effective today, I was working through the attorneys last week, is a letter that's being signed at closing by the borrowers, them understanding what forbearance is, and that they were qualified based upon their job and such. And we've had to, we can't say you can't claim forbearance, okay? But based on your current conditions, you can afford your payment, and you are telling us that you have no hardship as of today.
As of today.
Okay. Now, because what's happening is, like on Friday, a week ago, last Friday afternoon, I got a call from a realtor, and she said, Danny, I funded a loan this morning, or we closed a loan this morning. I just called my client It wasn't one of my deals, thankfully. I just called. She said, I just called my client and said, hey, the loan is funded. I've got a runner going to pick up your keys to bring them to you. He says, great. How long do I need to wait before I stop my mortgage payments?
Ouch.
And and she said, what, you just got qualified. They verified your employment this morning. And you're still employed. Did you get laid off? He said, no, but if I can stop my payments. That's what you're talking about, right, Mary? Yeah. And
They aren't reading, they're not looking at the repercussions.
oh my,
They're just
yeah.
hearing they can-
And that's what I think a social media campaign. I think
I'll be right back. Don't go away. I'll be right back. I gotta do
I
something.
think letting everybody know what it is and what it's not. What we know, we don't know if there are going to be some changes made to help people that had true hardship. I believe that when a file does go into, when they come back and they can't get caught up on payments, and somebody submits their paperwork, and they had plenty of money in the bank. I don't think the servicers are going to be sympathetic at all. I can even see, some reporters asking President Trump about this, and President Trump laying into somebody about, hey, when we said hardship, we meant, not just because you're in a way. So you can imagine how that conversation, I don't think he would have sympathy for anybody like that. I wouldn't.
Well, and I really do believe, and that's what this whole conversation is I agree with you. This needs to get out to have people read their documents and understand it. Because I've talked to people and I said, do you understand forbearance? And they're going, well, we don't have to pay for 3 months. And I'm like, no, that's not what it says. It says, yes, they will not let you pay for 3 months, but on the 4th month, you have to come current. And they go, no, they said they put it in the back. I said, there's no possible way they can loan modify every loan. And secondly, if they don't own it, if they are just servicing it, they can't modify it. It has to be the people that actually have the paper. And
yeah, and let me say this. One of the loan modification options, they go into the loan modification option. One of the options is that you get caught up on, is that, okay, you owe X number of months in payments, X dollars, they divide that over a 12-month period, and you make those extra payments per month to get caught up during a specific period. The other problem I started to mention earlier, and I forgot, is escrow accounts.
right.
We got the whole escrow account. So, 90% of all loans have escrows. You're not making your taxes and insurance, and the mortgage company is going to make those, and then they're going to insist that you catch them up, or that's going to be a 12-month payment. I mean, this is a bit of a it's a recipe for disaster. Everybody's just going to start getting upset about all these loans that now people are being made to catch up on, and so that's what I'm hoping that comes out from Congress and President Trump pretty quick of what this really means.
I mean, no one reads. That's the whole thing. I mean, they don't read the residential contract. Why would they read a loan?
Yeah, exactly. And part of the problem is you can't even CFPB, the Consumer Finance Protection Bureau, and I haven't looked since Friday morning, but they still gave no good explanation about it, and that just tells me that they don't know and what really is a forbearance, and what does really forbearance mean. So they're staying out of that conversation, which they should be. The CFPB should be protecting the consumer right now, and they're not. They're not talking about this. They should be.
So
Hey,
how
so-
do we get this out? How do we get this? I mean, that's what I talked to Hurdie and Cheryl, because I agree with you.
It's
We
got to be
put,
through
we
social
put, we
media,
put
guys.
stuff like this up and keep putting the message out, make it a big deal.
It, you know, here's what I'll do. I'll send you 2 different messages that I've sent out. One talks about what forbearance is and what the options might be at the end of the forbearance period. The other just says, you know, breaks it down that you're making $1,500 a month payment, and here's what goes on, and it kind of breaks. It's 2 different. It's a similar message, but one talks about options. One just says that that you have to start making the payments at the end, which is really what forbearance is. Otherwise, it goes into modification. So I'll send those to you, and it's social. I mean, you got to get social media going on it, and
That's why Cheryl's on here. Cheryl's going to be handling this video and pushing this stuff out. Hey, so Danny, we've kind of talked about this. Catch Mary up a little bit about what you guys are doing for training. I think she loves education. Tell her real quick why I got her on here. What y'all are doing.
Mary, we have we do a lot of training here at our training room. Or we'll come to you. We have classes. We have numerous training classes, and I can send you a list of that. But we lead with education. We have numerous 1 hour. We have 1 hour to 3 hour training classes, anything from what's called mortgage math camp to a class about selling with personality, talking about the DISC assessment to keeping your clients off of Zillow. We have a lot of different classes, and we also are Buffini trainers, facilitators, and we offer the Buffini. Where it's the 8-week, 2 hours a week class. And we do all of this in classroom or via live stream like this, and including the Buffini course. And we're working with Trek right now to have the Buffini, that 8 hours a week, 8 classes, 2 hours a week, having that for CE class also. So.
Oh, wow.
Yep.
Okay.
Yep. And the only thing we charge is the Buffini. His charge. The only class we charge for is a Buffini class. The rest of the classes are all free, including Legal 1 and Legal 2. And and all of this is face-to-face when we can go back face-to-face, and also online.
Okay. Yeah, I'm a certified instructor, so I do the Legal 1 and Legal 2 and all that basic
Cool.
stuff. But the other stuff, yeah, definitely we can talk.
Yep.
Like
yep.
I have to teach GRI this week via Zoom.
Okay. Yep.
Okay.
So, and by the way, Mary, I have a good friend that named Brett Wiskowski that that's really like Brett.
Yeah, you know Brett's dating my daughter.
Yeah. Yes. And
Small world.
Brett worked for us at Caliber.
Okay. Yeah. Okay. Yeah. He's just now moved over to Security National.
Yep. So, great guy. Great
Well,
guy.
hopefully you two can connect and stay in touch on some things. Mary Denny has been a good friend and been doing this almost 30-something years, really good. And Mary been, total education, every level in real estate, including a master's, right, Mary?
Yes, I have a master's in real estate.
How many people didn't have a master's in real estate? Come on. That's pretty cool.
Not very many.
And
I met your son a long time ago when you guys were all Caliber.
Yeah. Okay. Cool. Yeah.
all right. Thank you
guys.
guys.
All right. Well, thank you.
All right.
Thank
And
you so
I
much.
will. I'll connect with you guys on social media also.
Okay. You have my email to send me stuff?
Yeah, I do.
Okay.
Yep.
All right.
We do. And all right.
All right,
Sounds
guys,
good.
have a good day.
Thanks.
Thank you.
All right.
Bye.
Thank you.
Bye.